Okay, we are here with a June episode of the Habestat Canadian Real Estate Market Outlook. I'm joined here by my colleague Jeff Nader of the Habestat. My name is Daniel Foch. I am a real estate broker practicing in the Greater Toronto Area, and we're currently looking at the free tool on the habestat.com that basically compresses CREA, Canadian Real Estate Association data, and aggregates it into these easy to digest forms. So Jeff, what are we looking at here?
Yeah, and if anyone's interested in exploring this more, it's thehabstat.com slash analyze benchmark home prices. And yeah, like Dan said, we're basically separating it into 7 questions to address, specific questions you might have about the Canadian housing market. So what we're looking at here is, an index of basically how quickly our price is changing. And what we're seeing is the month over month percentage change. Right now we're looking at all of Canada and all home types. And so something a little different has happened recently, where we're actually seeing prices fall for 2 consecutive months here. So if we go back in time, the last time we've seen this is, 2019. So what does this mean though? Because realistically, prices fell 1.4% in April, another 2% in May. If we zoom out and kind of look at the actual average price or benchmark price over time, we can see that kind of results in that little blip there. Right. So definitely a change in momentum, but to go back to where we were pre-pandemic, right? There's a large difference still.
Yeah, I mean, when you have conversations with most of the people who are bearish on Canadian real estate or have been bearish on Canadian real estate, there's this imagining that a mean reversion might look like some severe whiplash, and we're just going to get straight back to that mean line, that dotted line within a couple of months or maybe a year. But the reality is it could take a lot longer than that, and it might not actually be a downtrend to get to that line. Like, the reality is the market could trade sideways for 6 years, and eventually we would be back at the mean. And prices will have, on average grown at just over the rate of inflation, or a couple, 2-3 times inflation, which is still too high. But the big takeaway here is nobody really knows exactly how a bear market looks in Canadian real estate, but I think it's unignorable, save for a few who maybe are willfully ignorant towards the state of what's happening in the Canadian market, that we've entered a bear market. We're balanced at best, and we're heading towards a buyer's market at worst. Obviously, and I'm sure we'll get into the sort of geographic comparison. You can see that prices have come down in the Canadian context. There are a lot of markets where it's hard to believe that, because, and I get people from all over the country telling me that I'm fear mongering on social media because their market is up 5% since the rate hiking cycle started, and our markets are down. Some of the higher price markets are down 15 to 20%. So it's going to start in. The fact that it's just a blip from my perspective tells me that, it's far from over. And you can see that long-term trend line that, a healthy market should ultimately return to, as much as it sucks to have to come to that realization. I think, if you go back all the way to the 90s, which is what people are making the comparison of how quickly credit increased in recent times. So this is the fastest acceleration in household debt costs that we've seen since the late 80s, and this is the fastest acceleration in the interest rate that we've seen since the late 80s. So what happened after 89? Well, house prices were declining from 89 until 1994, and it took them until 2002 to get back to their 1989 highs. If you talk about a mean reversion, that might actually be the healthiest way for things to happen. I don't people calling for a crash don't necessarily know exactly what that might, the consequences of that might be. But the reality is, I think a slower, longer, more sustained bear market might actually be healthy to give people the opportunity to trade in and out of it, right?
What would you say is the number one bull case and bear case right now?
Well, I think the bull case for everybody's bull case is immigration, right? But I think that we've learned that we're at record high immigration, right? And it doesn't matter if those people don't have capital, and we're seeing capital contraction. So now all of a sudden people are realizing that you don't really measure the value of a house in the people who want to buy it. It's not, a house isn't worth 400,000 people, it's worth $1 million. And if those people don't have $1 million, then the house starts going down in value. That seems to be the big bull case. I think the other bull case is just that we're seeing the utter debasement of currency, and the ultimate question of house prices is, do house prices always go up in value, or do any asset prices always go up in value, or does the dollar constantly lose value or lose buying power? And I think the latter probably is the reality, right? Housing just is it historically an inflation hedge, and it's not getting easier to build based on our legislative environment. So that's why it grows a little bit higher than the rate of inflation. The big bear case is macro, and then I think policy error on the government's part, and the reality that you know the Bank of Canada isn't in control here, and the bear case is that we actually have to follow the Federal Reserve. And the Federal Reserve goes a lot further than we do because they state their inflation at 8.5%, and we state our inflation at 6.8%. And so if they hike up another 200 basis points, we either look at one of two roads, right? Number one is we completely destroy the Canadian dollar value against the US dollar by not following them into the rate hiking. Let's say we back off after 125 basis points. Every 25 bips that they go up after that, we start to see the separation between the Canadian dollar and the US dollar. And now we've got, currency crisis, and inflation starts to ramp up again because now we're buying goods with crappy Canadian dollars.
Yeah.
So that's a horrible situation, right? But maybe values climb back up because Canadian dollar is worth nothing, and foreign direct investment starts to come by at a discount. Behind door number two is we follow the Federal Reserve all the way, and if they don't back off at another 100 basis points, then we've already seen the effect of 125 basis points on the overnight rate in the Canadian real estate market and in the Canadian economy. So, you slap another 100 on there, and I think things are going to be getting pretty ugly here. And I think we like to think that we're important as Canadians, but the reality is that the United States doesn't care about us at all, right? We're smaller than California. So if anything, actually, they want our economy to be a ruin because makes it easier to buy all of our businesses and resources that way.
I would agree with a lot of what you said. I think on the bull side, looking at equities, bond market, crypto, everything, there's no safe haven.
Right.
And real estate being a hard asset, if things continue the way they are, I think that's potentially one of the bull cases.
Right.
And then the other good point you mentioned, it's not getting easier to build, especially with interest rates rising, and that's not going to help our supply crunch that we have currently. So, great points. And so I think it's interesting if we jump to this part here. So look at where locations changed, which locations saw prices change the most.
Yeah.
And like you mentioned, it is quite different across the board, right? You're still seeing some places where you had 5% month over month growth.
Right.
So Sault Ste. Marie, of course, Bancroft leading the pack.
Yeah, I mean, although if you go to the Bancroft price chart, they did recoil pretty hard heading into the beginning of the year and bounce back up. So I don't know it's probably just ramping up for cottage season or whatever. That Bancroft's a tough one to track because the data is pretty bouncy. But what's interesting looking at this graphic specifically is outside of Ontario, a lot of these areas are faring pretty well. And to me, it's the reason for that is wages aren't that different in a lot of these other cities across Canada by comparison to Toronto. Toronto really doesn't do an exceptionally good job at given the talent that we have here, at wages being, it's not like New York City where wages are vastly different than the rest of the country. And so you're starting to see the impact of what that means for real estate in those economies. And it means that people who are buying in the GTA, especially in the suburban GTA, are using a lot of credit because they don't have a lot of savings, and they don't have a lot of income or a lot of income. And so the areas where are less dependent on credit, Newfoundland and Labrador, you're seeing price growth, right? Nova Scotia, you're seeing price growth. Calgary, I think, is even up a little bit since Fredericton, New Brunswick. There's a lot, I think most of Atlantic Canada, most of the prairies, most of central Canada, I think it's just basically Ontario and suburban BC that's down since the rate hiking cycle started. And that's because from my perspective, those markets are a little bit more credit dependent, and they might be, maybe we're seeing this evolution that they're a little bit more sophisticated and a little bit more forward looking than some of the other markets. I don't know. I guess we'll find out pretty quickly, but I think that the markets that weren't as credit dependent leading into this, they might have a little bit of resilience encoded as a result of that, because again, there's an inflation hedge built into housing, costs of construction going up, et cetera. But that's the interesting one to me, is that you're still seeing growth since the rate hiking cycle started, a lot of it across the country, right?
Yeah. And if we look at, basically cities with the benchmark price above 800,000, only Victoria that's the only city where prices grew month over month, right?
Right. Exactly.
Everything else kind of fell. And it's this lower price point where you're still seeing fairly moderate growth. And yeah, when we look at, the price of a home in say like Regina or Edmonton, Calgary, considering like there's still a good amount of people who have, pocketed a lot of cash so selling their homes in the past few years, right? In the Greater Toronto area. And so at this price point, people looking to kind of get out of that market, take their savings, this is still, pretty easy entry point for them, right?
Yeah, for sure. For sure. I agree. And you are seeing, like, I think a lot of the price acceleration that you're seeing in certain areas is a lot of that Ontario exodus phenomenon, right? Prices, coming down from people and people porting maybe equity from Ontario or savings from Ontario and going to other markets. And not, if they're buying a house, like, this is the thing, COVID did a lot to the marginal buyer and people who were buying for as end users. And they're less dependent on price than say your investor, right? Because they don't really there's a qualitative benefit that kind of allows them to be more forgiving with the price environment, right?
Yeah. All right. So maybe I'll kind of give you a challenge here and see, since let's say April 2020, what cities do you think have jumped up the most? If I go into the next page and look at that comparison.
I think I know this because I posted them all over Twitter, but I want to say Halifax. I think it's Halifax. In Ontario, it's Windsor. Yeah, I missed everything but the Sioux. Yeah, the Sioux I forgot about.
All right. So in terms of
year over year
change, this is from April 2020 to May 22.
Yeah, so beginning of COVID. Okay.
Yeah, North Bay doubled.
Love it.
Bancroft almost doubled. Kawartha's almost doubled, right? And so looking at this list, I mean, what stands out to you as maybe some locations where more likely for correction versus, this is kind of, an adjustment to new pricing in some places?
Yeah, I mean, look, like it varies market to market. I'm going to say that the cottage country, I think there's going to be some liquidity issues there as prices start to come down. One, it's a luxury good. So these are goods that, tend to go first. They don't have an extreme amount of resilience in in a recessionary environment. And then as liquidity, if people are trying to exit cottages and they go back to, even if they just return to their previous sales cycle, which was 60 plus days, right? It took 60 plus days to sell a cottage. Like, now all of a sudden you have an asset that costs people money. It costs a lot of money to own a cottage, right? It doesn't have a ton of value when you're not using it. So I could see that. I think like your North Bay, Bancroft, Kawartha, those are going to have those impacts. Look, Sault Ste. Marie, I can't really see how a place like that can come down that much in value, just because they're at the absolute price floor, and you literally couldn't build a house and even if you depreciate it to 10% of its build cost, if it's absolute, if it's a gut job, you couldn't provide housing for as cheap as you can buy it in a place like that, right? And there's a lot of markets like that in Ontario. So to me, that's a little bit where the inflation hedge is there, and the unless the only way a value of a house that's trading that far below replacement cost comes down in value, from my perspective, is if the labor market gets destroyed or demand destruction somehow brings down the cost of lumber and all these input costs construction, which I don't really see happening massively, right? Like a place like Moncton. I mean, look, Moncton has traded like a cryptocurrency for years, right? It's pretty bouncy. I think that one's probably due for a little bit of recoil. Um, Most of the other,
maybe
like,
if we go
yeah,
down to the bottom of this list,
yeah,
even though the lowest performing one, St. John's, right?
yeah,
Um, uh, Saskatchewan, a lot of the prairie cities, they're still up. If we take out this bottom five, between over 20% in
yeah.
just over 2
Since the
years.
beginning, yeah.
Yeah.
Yeah, it's funny too because like those markets, from my perspective, are the ones that I'd probably actually be most bullish on in the Canadian market. Like I think anything with oil exposure is an obvious pick right now, and I don't think that energy costs are going to be correcting. At like I mean I think that demand will bring them down over time, but like the other thing is exposure to precious metals, to energy sources, right? Like Saskatchewan, as an example, you got potash, you've got natural gas, you've got agriculture. Like we're seeing a lot of disruption in the global supply chain of grain, as an example, right? So these are markets which, from my perspective, like a more of a pure play, if you're thinking from an investment perspective. And it surprises me that they haven't grown, because they weren't, and that shows me that how the market's behaving, right? It's saying, okay, people are going to those staycation places, right? Like the sexy city. I'm changing. I'm moving to Moncton or Halifax because I'm done with Ontario because of COVID, right? And I want to have a detached house in a walkable city or whatever.
Yeah, makes sense. All right. Anything else you want to touch on here?
No, I mean, I just the data is really interesting to me. I could look at that chart all day.
Yeah, I mean, there's too much in here to go through in
Yeah,
one
for
call
sure.
here.
For sure.
I would definitely recommend people, if you're interested in buying or selling your city, just keep track of what's happening here, and not just in terms of prices as well. It's also good to watch supply metrics, understand, how often are new listings coming on the market? What does your active inventory, months of inventory look like, right?
Yeah.
Those are going to kind of tell you, where things could be going in the next couple of months.
Yeah, for sure.
Well, cool. Good chatting. And I think we'll cover Greater Toronto area here in a couple of weeks.
Yeah, I guess CREA Data is more on the 15th, and we'll do the GTA. I guess you're away for the next GTA one, but I'll get a cool co-host to do that one with me. And yeah, I mean, I think going to be interesting to see how, if and when any of these markets actually roll over across the country, similar to how the GTA has.
Yeah, exactly. For me, I'm watching really this one to understand, is this momentum going to continue? Are we going to see, bounce back? Is it going to fall sharper?
Do you want to actually just quickly click on the how to various cities compare over time chart? I just want to see that one, because I think everything except for, or I think that you're just seeing GTA and Vancouver. Even Vancouver is like sort of just at plateau. Ottawa rolling over a little bit. But if you look at like your Calgary and Montreal, they're still ripping, right? Like, and
they are. Yeah.
I mean, it looks like they're plateauing a little bit, but yeah, it's crazy from my perspective to see.
Yeah, and there is a slight, I guess, a time lag in the HPI, right?
Yeah.
So it's possible that some of these changes, we'll see better reflected in next month's video.
Yeah, I think that's true, and they also recalibrate the HPI this time every year. So, but yeah, it is interesting. Like I think Windsor Essex, I posted something on TikTok and Twitter, maybe saying like, oh, I was so blown away that it was up like 20% since the rate hiking cycle started, and somebody who was a local in that market said, no, prices are down like 20% here. The HPI just isn't accounting for it yet, right? So. Yeah, again, like it's going to be interesting to watch how data changes over the next couple of quarters, especially.
Yeah, completely.
I guess maybe we'll take a bet, because we'll have a rate we'll have a rate announcement between now and the next report, so the next CREA report. So how many bips do you think TIFF's going to add to, like, because the bank or the Federal Reserve just did a 75 shot. So do you think Canada's going to match it?
Yeah, I'm expecting 75, and then from there, I could see them slowing the hikes for sure.
Yeah.
I mean, we've already seen the impact, not
Yeah.
just in housing, right, but
Equities, crypto.
across. Yeah. So yeah, it's a hard one to balance.
Yeah, I'm interested to see.
Don't envy their role.
I think they're already going to start backing down. I think they'll only put 55 in, so I'll take that bet. We'll do a dinner when we're in
right.
Toronto next. All right, man.
There
Thanks
we
for your
go.
time. Okay, buddy. Talk
See
soon.
ya.